Hello and welcome everyone. Thank you for joining us today. My name is Steffi Silverstein. I'll be talking today about the New Jersey bulk sale law. And joining me is Len Nitti, and he will be discussing sales and use tax considerations for real estate in New Jersey. Okay. So before we begin, just a few housekeeping matters. For those who are requiring CLE and CPE credit, we will have some polling questions along the way, and you must answer those and complete all of those for the credit. If you have any questions, please use the questions pane in the GoToWebinar dashboard on your screen. We'll try and answer as many questions as possible at the end of the webinar. And this webinar is being recorded and will be uploaded on our website. And for the CPE or CLE credit, kindly return the evaluation form, and we've provided the name and email address, and your certificates will be emailed to you within 7 to 10 business days. With that, let's begin. The New Jersey bulk, I'm on page 4. The New Jersey bulk sale law has been in existence for many years, but in 2007, the law was expanded to apply to all transactions involving the sale of business assets, with the exception of inventory. And the purpose of this law is to allow the division time to review the seller's tax accounts to determine if any outstanding tax liabilities can be recouped at the time of sale. So this is their last chance, in a way, to get any taxes that are owed by the seller. Now, New Jersey has an extremely broad definition of a bulk sale, including even the sale of a singular business asset. And obviously included in this broad definition, assets subject to bulk sale law are real estate transactions. So what are some examples of real estate transactions to which bulk sale law will apply? It includes the sale of rental real estate, the sale of vacant land, sale of real estate used in a trade or a business, and the sale of any real estate other than inventory owned by a business entity, whether it's a corporation, a partnership, or an LLC. It also applies to 1031 like-kind exchanges and installment sales. Additionally, it applies to the sale of a stock or a partnership interest or membership interest owned by a business, because that's considered a business asset. It applies to transactions involving a deed in lieu of foreclosure when the property is for income-producing property. It applies to a short sale, again, if the property was used for business or income purposes. It applies to auction sales that are not court-ordered, and it applies to tax-exempt and nonprofit organizations as well. Although they don't pay tax, they still may have other filing obligations, and New Jersey will want to see all those are satisfied. What are some examples of transactions that are exempt from bulk sale law? The sale of a rental of a simple dwelling house, defined as 1 or 2 family homes, that is owned by an individual, estate, or trust. Those that are in real estate and have inventory, such as builders or real estate dealers, this law does not apply. Now, the sale of the stock or partnership interest or membership interest that is owned by an individual, the bulk sale law does not apply, as that's considered a personal asset. Formal foreclosures, the bulk sale does not apply. Those that the property goes through a formal foreclosure process and a sheriff's deed or marshal's deed is issued. I just want to show you an example of how this relates to a partnership or membership interest. Again, if it's owned by an individual, the bulk sale law does not apply. But if it's owned by a business, then the law applies. And on page 9, we have a simple example. So if Joe Smith sells his membership interest in Real Co. LLC to Paul Jones, then the bulk sale law does not apply, and this transaction is not subject to this because this interest is being held as a personal asset. But if Smith and Sons LLC sells its membership interest in another entity, Real Company LLC, to Paul Jones, in this example, the transaction is subject to the New Jersey bulk sale law because this interest is being held as a business asset. So this is our first polling question, and the question is, transactions involving 1031 exchanges are not required to comply with New Jersey bulk sale law. True or false? So that polling question is closed, and we have 85% responded false, and that's the correct answer because transactions involving 1031 exchanges are still required to comply with the New Jersey bulk sale law. Okay. So what are the responsibility of the purchaser? It really is on the purchaser to get this going, and it's mostly the purchaser's attorneys who will need to address it for them. So the purchaser of a business asset in any bulk sale transaction is responsible for notifying the DOT at least 10 business days prior to the closing that the proposed sale will be taking place. And this is done via Form C-96 notification, and it's typically filed by the purchaser's attorney. Again, the purchaser is the one who's going to be responsible for complying with these laws. And if the purchaser fails to provide this notification or does so in less than the 10 business day notification period, it's considered a bulk sale violation. And if there's a bulk sale violation, the New Jersey says the purchaser who was responsible to do this may now become liable for any of the outstanding tax liabilities that's owed by the seller. And within 10 days of the filing of the bulk sale notification, the division will then forward a letter to the purchaser notifying them of how much of the purchase price that has to go into escrow. And once the purchaser receives the notice of the required escrow, the agent must withhold this amount from the sales proceeds. And this applies even in a 1031 like-kind exchange or where there is no cash at closing. What's the seller's responsibility? So after the purchaser files the initial form, the division will also request information from the seller. As part of this request, the seller will need to complete Form TTD Asset Transfer Tax Declaration, estimating the taxable gain or loss on the sale, and additionally an estimate of current year's operating losses if applicable, gain deferral due to a 1031, or terms of an installment sale. All this information appears on the form, and it helps the New Jersey determine how much of escrow is going to be withheld. If the entity typically sustains a loss, or in the year of sale, for example, will have a rental operating loss, perhaps the tenant has vacated, and you'd want to include that and reduce the gain of the sale so that the bottom line is lower and the escrow will be lower. This form should be filed and submitted as quickly as possible, since the information on it can reduce the amount that will be escrowed. In addition, the division will want to escrow withholdings on net gains allocable to non-resident owners. But if there is a transaction where some withholding has already been taking place, you should advise the caseworker that is assigned to the case that there is additional withholding on prior transactions. The division will also require the seller to file any unfiled tax returns and pay any outstanding tax balances. The failure to comply with this request will result in the entire amount being escrowed and withheld as a tax payment made on behalf of the seller. And this can be especially damaging in a 1031 exchange, because all proceeds typically have to be reinvested in order to defer the gain. Once the division reviews all the documentation provided, they will issue a letter instructing the purchaser to either release the escrow to the seller or to remit a required tax payment to the division. The Form TTD Asset Tax Declaration form should be submitted once the case is assigned to a caseworker. When the instructions say that once, if any of the owners are other than individuals, then not to complete the rest of the form once you arrive at the gain calculation, as they are going to do that for you. What they do want is a membership directory, and typically we include an attachment, and we list all the owners, their federal ID numbers, and I also advise if any are non-residents. And then if they'll determine if any withholdings will apply to the non-residents, and will provide a certificate to report as a credit on the entity's tax return. We're going to see an example of that in a minute. In general, the escrow that is being withheld is calculated using several factors, including, but not limited to, internal and external information, tax liabilities that the division has determined are owed, any audits, any of the projected gain from the sale, as well as unfiled returns, including final returns and non-resident withholdings. And to some extent, it's up to the discretion of the caseworker. The instructions say that for those who are non-resident owners who are selling real estate, they're required to remit the greater of 2% of the purchase price or 8.97% of the gain. However, you'll see in a client example how that the amount that was held as escrow was neither of these. And this is a portion of the division's initial escrow. So the escrow that is being requested to be withheld can be reduced once the caseworker receives the asset tax declaration form, any payment of deficiencies or audits, and the filing and payment of any delinquent returns. And the escrow will be released once the division is assured that all of the obligations of the seller have been met. And they will issue the purchaser a clearance letter advising them that the escrow can be released or what balance should be held back. And what if there are no proceeds from the sale or the transaction, or the proceeds are insufficient to meet the escrow amount required by the division? It's still the purchaser's responsibility to withhold an escrow amount, and it's going to be between the purchaser and the seller to decide how those additional funds will be satisfied at closing. This is an aside that I've observed in working with clients with withholdings for non-residents. The seller should be cognizant of how the estimated tax withholding is treated on their books and records, and it should be considered a distribution to that particular owner, whereby any subsequent cash distributions should be taken into consideration. So basically, in an escrow amount, there could be something withheld for non-residents, but those non-residents are going to get a benefit when they file their personal income tax returns at the end of the year. So I've provided an example on what I see some of the struggles that some clients have. In my example, we have two partners. They're 50% each members of a partnership. Partner A is a resident, and Partner B is a non-resident. And assume that New Jersey has advised that they need the purchaser to hold back $100,000 in escrow for the non-resident withholding. All other escrow funds have been released because the seller had, after New Jersey did their due diligence, there was nothing owed. So if there was $400 in an initial escrow, $300 New Jersey said give back to the seller, $100 remit to us, and we're going to hold that on behalf of the non-resident. And in this example, the net sales proceeds was $3 million. Escrowed for New Jersey withholding was $100,000, so the partnership received cash of $2,900,000. If there was no adjustment for the withholding, and in scenario one, the cash was distributed straight up 50-50, then Partner A will receive $1,450,000 as a distribution, and Partner B will receive $1,450,000. And then when Partner B at the end of the year files their non-resident New Jersey income tax return and has a tax obligation on reporting that gain, they don't have to reach into their pocket if the tax is $100,000. They already have a credit sitting with the state. And so they get a benefit of $1,550,000, whereas the resident only received $1,450,000. And by the way, this withholdings for the New Jersey non-resident is strictly an estimate. When the non-resident ultimately files their return, all factors will be, the tax return will determine whether the 100 was too much or too little. If the 100 was too much, then they'll get a refund. If 100 was insufficient, then the taxpayer will have to pay the difference. So it's just an estimate. What really should happen is if there's $2,900,000 to distribute, in order to equalize the partners, the first 100 should go to the resident. The balance of $2,800,000 should be divided 50-50. So at the end, Partner A will receive $1,500,000 in cash. Partner B will receive $1,400,000 in cash. But again, when they file their personal income tax returns, they will get a credit of $100,000, and they will end up with $1,500,000, and the two partners will be equal. I don't know if any of you have ever encountered this working with clients, but I do see this, and just thought I would mention it in case it's helpful. So this is our next polling question. The seller is responsible for notifying the Division of Taxation 10 business days at a closing. True or false? I guess this was a little bit of a tricky question because we have 64% true and 36% false. It's not the seller's responsibility, it's the purchaser's responsibility. So the division is looking to the purchaser to make this happen. So in transactions where any of the attorneys are representing the purchaser, you really want to protect the purchaser and comply with these laws. I wanted to give you an example of a timeline of a recent client of mine, of their transaction, and what really happened at the end of the day. So this was a relatively small transaction. You add a few zeros and the numbers become a little bit more material, but here we had a sale of real estate of $3.6 million, and the projected gain was $3.2 million after closing costs and remaining tax cost basis. there's very little basis here because this property was held in the family business for a very long time and it was almost fully depreciated. So most of the sales proceeds was gained. The partnership had 4 owners. One was a non-resident individual, and the other 3 were partnerships. So this is a multi-tiered partnership, and at the top level we have 1 individual that's a non-resident and 3 partnerships. The portion of the gain estimated that was applicable to the non-resident individual was $708,400. So, by the way, the closing date here appeared to have changed a few times. But if we start out on June 10th, the purchaser remitted Form C-9600 to the Division of Taxation, notifying of an upcoming transaction. And a week later, the purchaser received a letter stating that there's going to be an escrow requirement of $327,000. At the same time, they sent the purchaser to forward to the seller a request to complete the TTD form. So the closing date was changed, and it was scheduled for July 15th. Ultimately, it was July 29th. 2 days prior to the closing date, the purchaser received another letter saying that there was going to be demand for escrow for $47,462. This is not in addition to the $327. This is part of the $327. And when I couldn't figure out how they got that number, but when I divided that over the non-resident portion gain, it was about 6.7%. The actual closing date was July 29th. And on the HUD statement, you'll see we saw an escrowed amount of $327,000. 2 weeks later, after the closing, the purchaser received a clearance letter from the division, and it said that you can release $279,000. And a week later, the partnership received a refund check from escrow for $279,000, which was the $327,000 initial amount less the $47,000 withholding to the non-resident. So you could see when all is said and done, the closing was July 29th, and within 3 weeks they had received their escrow fund monies back except for the non-resident withholding. In most of the transactions, and it's not all the transactions that I've seen through my clients, all escrow monies have been refunded except if there's non-resident withholding, because for the most part, the seller has been compliant and there are no unpaid taxes on their end. So once the division has determined that the seller is good to go, they'll tell the purchaser, go ahead and release the escrow. This client, 5 days after they received their check from escrow, proceeds to make partnership distributions to all the partners in proportion to their ownership interest. And they didn't take into consideration the non-resident withholdings for the $47,000. Despite the fact that I work with this client continuously throughout the year, they have other non-resident withholding obligations as well. And a few days before the closing, I advise them, you must be sure to address the non-resident withholding before you do the distributions to equalize things. Yet it appears it's still confusing to clients, and they did go ahead and distribute the remaining cash in proportion to the partnership ownership. So in summary, complying with the New Jersey bulk sale does not result in an additional added tax cost to the transaction. If the seller's tax accounts are current, if their payroll taxes, their sales tax, corporate taxes, filing fees are all current, then the escrow funds will be released. And you could see in this one example, it's within a relatively short period of time. But buyers should be diligent in complying with this in order to minimize their exposure should the seller be non-compliant on their tax returns. So the escrow holdback is really just a cash flow timing issue. Non-residents should recognize they're receiving a distribution in advance in the form of a prepayment of their personal state income taxes. And certain real estate transactions are not plain vanilla conveyances, and this causes sometimes the compliance with these laws to be challenging. You know, we have the quick closings, the sign and close deals, the joint ventures. Some of these are not plain vanilla conveyances. And unfortunately, the current resources are somewhat limited. And the division has not provided regulations further clarifying the application of the bulk sale law. It's best to communicate with the caseworker if there are any questions. And in summary, if in doubt that does the transaction require to be complied, there's no harm in filing at the end of the day. Okay. And now let me introduce you to Len Nitty.
Thank you, Steffi. So before we get into the presentation on sales and use tax considerations for real estate entities, let's just talk about a couple of real basic items when it comes to sales and use tax. I find just about everybody has a general understanding of sales tax because everyone's used to paying it when they buy something. You know, general definition of what sales tax is that it's a point of sale tax on transactions involving products or services that the state subjects to tax. Where people get a little confused is when you start talking about use tax and what is use tax. Essentially what use tax is, it's the mirror of sales tax, and it's the tax on the use of items or services subject to tax where sales tax wasn't collected at the point of sale. So let's be clear, use tax only kicks in if you're using taxable products or purchase a taxable service in a state where no sales tax was collected. So you don't have to pay both sales and use taxes, one or the other, to essentially capture the tax on the taxable items. And currently in New Jersey, sales and use tax is charged at a rate of 7%. So let's get into some of the general rules on sales and use tax. Generally speaking, purchases of tangible personal property are subject to sales and use tax unless a specific exception applies. So in terms of real estate entities, sales tax is going to be due on purchases of parts, materials, cleaning supplies, anything along those lines. Some common exceptions that you may see are going to be clothing, including uniforms that you may purchase for your employees. Additionally, disposable paper products like paper towels are also going to be exempt from sales tax. Generally, purchases of services are not subject to sales and use tax unless specifically identified as taxable. The majority of your professional fees will not be subject to tax, whether it's legal fees, accounting fees, management services. Those all qualify as exempt from tax. Some common services that would be subject to tax are going to be landscaping and lawn care, pest control, and snow clearing. And we'll talk about other repairs and maintenance as we move a little further along in the process. It's also important to note that the accrual method is used for sales and use tax. What that essentially means is the tax is due when the transaction occurs, whether or not payment has been paid or received at that point in time. That's generally what the accrual method is, where the cash method would base everything on when you actually cut the check or when you receive the cash. So it's important to note that sales tax is due if you sell something that's subject to sales tax, regardless of when you get paid for it. And the other thing to note is if you are selling anything, and we'll talk about some common items that may be subject to sales tax that a real estate entity may sell to some of their tenants. the sales tax must be separately stated on the invoice so that the purchaser knows that they are paying the sales tax. So a popular item for real estate entities are capital improvements. And capital improvements are the installation of tangible personal property which increases the value or useful life of the real property. These items must be permanently affixed to the real property. And we'll talk about some examples in a moment. And the key to having it treated as a capital improvement is that the installation charges for the labor on the capital improvement are going to be exempt from tax. Parts and materials for capital improvements will be exempt from tax if they're provided by the contractor performing the installation. Now, that doesn't mean that these parts and materials are not taxed at all. What essentially happens is, in the state's eyes, the contractor is determined to be the end user of these materials and supplies and parts, and they're the ones that are subject to pay the sales and use tax on it, not the business or person that's purchasing the capital improvement. If the parts and materials are not purchased directly from the contractor but is purchased from a third party, they will be subject to tax. So to give you an example, if the owner of a building purchases a large boiler and they buy it directly from the manufacturer, the purchase of that boiler would be subject to sales tax. Now, if they hire somebody to install the boiler and affix it to the property or the real property, the service for the installation, which results in the capital improvement, would not be subject to tax. On the flip side, if you contracted with a contractor to come in and provide both the boiler and the service to install the boiler, the entire invoice would not be subject to tax. Some common examples of capital improvements are going to be new siding, driveway paving, new fences, new roofs, the clearing of land for construction, underground sprinkler systems, and the initial painting of new construction. So unfortunately, just because you get the capital improvement status, New Jersey back in 2006 had changed the law and determined that some capital improvements, they are going to subject to tax now. So capital improvements included, which are considered to be landscaping, security systems, carpeting, other floor coverings, paintings and wallpapers are going to be considered to be maintenance unless for new construction. Examples of landscaping is going to be your planting, your seeding, the installation of sod. Note that hardscape, whether it's a fence, decks, patios, retaining walls, those are not considered to be landscaping. Those will continue to be exempt capital improvements. When it comes to floor coverings, hardwood, ceramic and vinyl tiles, linoleum, if it's going to be glued to the floor, those are all examples of taxable floor coverings in addition to carpeting. That brings us to our third polling question of the day. Materials purchased for a capital improvement are not subject to sales and use tax. True or false? So it looks like the vast majority answered false, which is the correct answer. 80% answered false. The materials purchased for a capital improvement are always going to be subject to sales and use tax. It's just a question of who pays the tax. If the contractor who's providing the services for you purchases the materials and parts, they're going to be paying sales tax on it. If you purchase the parts directly and then separately hire somebody to install them, you will be paying for the tax on the items that were purchased. So let's talk about repairs and maintenance. So repairs are going to be work which maintains the existing value of real property. And you know, that's not the greatest definition of the world that the state provides to us, because you know, I could think of many things that the state considers to be a repair which once done, does improve the value of real property. Take, for example, a 5-foot hole in a roof. Someone's willing to pay a lot more for a building that has a full, complete roof than one that has a hole in it, knowing the wear and tear that rain and other weather getting through there will do damage to it. But that's the state's general terminology. The labor for repairs and maintenance is subject to sales tax. The parts and materials are not subject to sales tax if the contractor provides the parts and materials and they separately state it on the invoice. The same theory applies with the capital improvements. If the contractor is providing the parts and materials, they're deemed to be the end user and do pay tax on that. So if they separately state it on the invoice, the state will not double tax those parts and materials. However, if they don't separately state it on the invoice and there's no way to know how much tax or how much the parts and materials cost them, the entire invoice is subject to sales tax. And same as goes for capital improvements, parts and materials not purchased from the contractor will be subject to sales tax. Also note that maintenance contracts are subject to sales tax, whether it's a long contract or any sort of maintenance contract would be subject to sales tax. So some examples of repairs and maintenance: patching and sealing the driveways, repairing cracks in concrete, pointing of bricks, fixing a leaking roof, plumbing repairs, replacement of a section of the fence, would all be examples of repairs and maintenance, along with the repainting of a wall that was previously painted during new construction. So, capital improvement versus repair. The challenge with making this determination, which can be pretty sizable savings if you can get to a capital improvement status, is the state doesn't provide us any clear bright line test to determine if the work being done results in a capital improvement or a repair. The determination ends up being based on facts and circumstances, and New Jersey tends to be pretty aggressive on audit in trying to reclassify things that a property owner does a capital improvement by reclassifying them over to a repair so that tax can be collected. To give you an example, if you replace 5 or 6 tiles on a roof, that would clearly be a repair. If you replace the entire roof, that's something that's going to be clearly a capital improvement. But what if you replace 25% of the roof? Does that cross the line from being a capital improvement or repair? Maybe. If you replace 50% of the roof on the building, does that get you to capital improvement status? You're certainly getting to a better argument for capital improvement status. 75% of the roof, that probably gets you there, but again, there's no clear bright line test that the state gives you. And a lot of times when you're working with an auditor, it depends upon the auditor and what the definition in their mind is, whether they're going to consider it a capital improvement or repair. One thing that I find really helps when dealing with an audit is making sure that the language in the contracts that you enter into with the contractors doing the work is to make sure that the language supports the position that you want to take. If you feel that something's going to result in a capital improvement, you want to make sure that the language in the contract isn't referencing repairs and words like that that's going to make just an auditor who's reading it make it sound like it's a repair. You want to make sure it's using words like replacement and new and different things that make it sound like, it's going to make it sound like a capital improvement, especially with how aggressive New Jersey is in this area. So if this is probably more common in an apartment building context, where a lot of times apartment owners will offer to their residents to utilize their maintenance people for a charge to do in-unit repairs for them. The labor charges are going to be subject to tax if you're providing this sort of service to the residents or any of your tenants. Parts and materials would be exempt if separately stated on the invoice. And again, the presumption would be that the building owner has paid the sales and use tax on the original purchase of these items. Some other transactions to consider. The first one's a big one for use tax considerations, is when you're making out-of-state or internet purchases, a lot of times these businesses won't have what's known as nexus to the state of New Jersey. What nexus is, it's a strong enough connection to the state to require the business to collect sales tax at the point of transaction and turn it over to the state. So a lot of times when you're buying out of state or on the internet, they're not going to charge a sales tax, so you're going to have to self-assess use tax and turn it over to the state yourself if what you're buying is a taxable item. This is another one that's more applicable to apartment buildings, but if you have a health and sports facility on the premises and you're charging a membership fee for the owners to use that, meaning that it's not just included automatically in their monthly rent, those fees for membership would be subject to sales tax. Sales tax would have to be collected and turned over to the state. You would note that if you're running any sort of fitness classes there and have a separate charge just for the fitness class, that would not fall under the membership fees category, and those would not be subject to tax. Additionally, parking charges to non-residents is something that New Jersey taxes. You don't have to worry about it on charges you make to your residents or your employees for parking, but if you have a separate daily fee or some sort of a fee for non-residents that you're charging, those are going to be subject to sales tax. So let's talk now about urban enterprise zones and some of the benefits for sales and use tax that they are going to provide for us. Urban enterprise zones, or UEZs, are an incentive program to really geared towards economically distressed business districts. Currently, there are 32 UEZs. Some examples of UEZs are going to be Newark, parts of Jersey City, New Brunswick, which is right down the road from us. There's 32 within the state. The UEZ program provides tax incentives to qualifying businesses, and in order to be a qualifying business, the business must apply to receive UEZ status. Simply operating your business in a UEZ doesn't get it done. You actually have to apply and be approved for UEZ status. So in order to be considered a UEZ business and have your application approved, you must demonstrate to the district that you're either going to create new employment in the UEZ, 25% of which must either be located within the UEZ, be unemployed for 6 months or more, or determined to be low-income individuals. There is an alternative to the new employee test for substantially contributing to the economic attractiveness of the UEZ. I think when you're dealing with real estate, you can make a case that you would qualify under here by paving new roads, putting in sidewalks, very nice landscaping. It's also important to note that although it's a state incentive program, it is administered by each of the districts. So you're dealing with 32 individual districts that may have different interpretations of these rules, which can make it a little challenging. The main benefit to being a UEZ business is that you're going to get a sales tax exemption on the purchase of tangible personal properties to be used in the UEZ, with the exception of motor vehicles and energy. So that's a complete exemption from sales tax on the purchase of tangible personal properties. Think of the savings that you get when you're building a building if you don't have to pay tax on all of your materials, parts, and supplies that are being purchased. That's a pretty huge savings. So it's worth, once you enter into that district, to make sure you do get applied before you start construction if you're going to be building a building in those areas. Very important. Also, purchase services are going to be exempt if performed at the UEZ location, with the exception of phone, motor vehicle, utility, limo, and storage services. So to look back to how you're creating employees for a second, I did forget to mention one challenge there, is the state's really provided very limited guidance in how you deal with leased employees. And leased employees are becoming more and more popular now because of PEOs, professional employer organizations, where you're essentially outsourcing your payroll and HR function to a third party. And even though these are still more or less common law employees of your business, you're not filing any payroll returns. And depending upon who you ask at the state, they either don't really understand what a PEO is, or their initial reaction is, well, if you don't have payroll and you're not reporting payroll to the state and turning over taxes, you don't qualify. In a few of these districts, I found that the administrator does understand what leased employees are and will allow for the UEZ benefits, but it seems like there's a big disconnect with the state here because they just haven't publicly gone out and given a position on leased employees specifically for PEO types of organizations, which are, as I said, are becoming more and more popular. So if you're a business in a UEZ which is having some level of sales, similar to what we discussed earlier, a sale by a UEZ business qualifies for a 50% exemption for the sales of tangible personal property. So if you're selling anything to unit owners or tenants, those sales would be of tangible personal property would be subject to the 50% sales tax exemption. So you'd only have to collect the 3.5% rather than 7%. It's important to note that it does not apply to the sale of services. So for in-unit repairs or any other taxable services you may provide, it's not going to apply there. And also note that restaurant prepared food sales do not qualify for the exemption if anyone has a restaurant in the building that they own. So that brings us to polling question number 4. All purchases made by a UEZ business are not subject to sales and use tax. True or false? So this one's more or less split. We have 60% saying false and 40% saying true. The answer is false. While most purchases made by a UE business are not subject to tax, there are certain exclusions like for motor vehicles where those will continue to be subject to tax. So some common exemption forms when dealing with sales and use tax. Form ST8 is what you're going to complete and fill out to give to your contractor for capital improvements so that they don't charge you tax on the project. ST3 is for sales for resale. So if you do have any sales of tangible personal property, any tenants, and you are holding those for resale, you would present at the ST3 to your vendor so they don't charge you sales tax, and you'll collect the sales tax from the end user. And UZ5 is for urban enterprise zone businesses. This is your exempt form, which you would give to all of your vendors to show that you're a qualifying UZ5 business or urban enterprise zone business. This particular form is issued directly by the state. It has to be directly issued by the state in order to be accepted. Some common resources you may want to consider. New Jersey has a sales and use tax guide that provides a list of number of services and items of tangible personal property which are exempt and also taxable. New Jersey Sales and Use Tax Guide for contractors will provide you more information about capital improvements and repairs and maintenance, when tax is due. And NJUEZ has a frequently asked questions that's pretty good, provides a number of answers for businesses located in UEZ, whether it's how to qualify, how to apply, and exactly what would be subject or not subject to sales and use tax. Included in those questions will be how you apply to begin with and how you reapply to continue your certification going forward. So that brings us to any questions that anybody has. I don't think we've actually received any questions, so hopefully we've covered everything that everyone was hoping to get out of this. Any closing comments, Seppi?
No, we got our 50 minutes in, right?
Yep, so everyone can get their hour of CPE or CLE.
And certainly if anybody has any questions, we've provided our contact information. Feel free to give us a call, either Len or myself, and we'd be happy to answer any questions.